with Kanoko. Thanks for joining our meeting on taxes, everybody's favorite subject at the beginning of the year. Thanks everybody in person for joining and online. So if you're online, you can put questions in the Q&A, not the chat. I am going to now just turn it over to Aini and Carolyn. Welcome. Thank you.
You're welcome. This is the third one that we've done. And I just want to introduce our firm. It's very small. We have a lot of real estate experience. For those who have been around for a while, we were the accounting office for Zephyr Real Estate for about 30 years. And we do a lot of individual returns for property owners and LLCs and S-Corps. A lot of times realtors will move into an S-Corp situation when it becomes advisable. And we will be glad to talk to any of you. And here is Carolyn. I'm sorry about that.
Hi, I'm Carolyn Gersovitz. I'm a CPA specializing in tax. And as Aini mentioned, we are a small but mighty firm. And we have a lot of experience with realtors. And I think what kind of sets us apart is we take a practical approach to taxes. So as you'll hopefully get from this presentation, we're able to talk to you in a way that isn't a foreign language and answer your questions within the letter of the law, but with a practical spin. So I will just kind of cover some common questions that come up, just an overview of taxation for realtors, and then we'll open it up for questions. So most of you operate as independent contractors, meaning that you don't have taxes withheld from your commissions. So that means it's kind of on you to manage and pay your taxes as the year goes along. And that includes a 15.3% self-employment tax. So when you're a W-2 employee, your employer withholds your portion of taxes, and then they also pay an employer portion of payroll taxes. When you are self-employed, you have to pay it all. So it ends up with additional taxes being paid. However, you can claim deductions against that income. When you're a W-2 employee, there's not much you can, really claim related to your employment. When you are self-employed, there's a lot that you can claim, which we'll get into. But first, I'll go into the LLC versus, an S-Corp. So setting up an LLC is quite simple. If you are the sole member of the LLC, it is disregarded as a separate entity for federal tax purposes, meaning all of the activity is included on your Form 1040 on something called a Schedule C. There is a form that needs to be filed with California called a Form 568, but it's super duper simple. And really, you're just paying most times the minimum franchise tax for the privilege of doing business in California, which is $800. If you have receipts over a certain amount, you may end up paying more than that. But it's pretty straightforward, and having the LLC protects your personal assets. But all of the profits are subject to that self-employment tax. It all flows through, as I mentioned, to that Schedule C. Whereas with an S corporation, you could pay yourself a reasonable salary and then take additional profits as distributions, and the distributions are not subject to that self-employment tax. So that's a benefit of setting up an S corporation. However, it comes with more of an administrative burden because you need to keep, separate books and records. You have to file a separate tax return. So there is a little bit more that comes with that. So you kind of just have to weigh the pros and cons to figure out whether that makes sense. And we can certainly help you to do that. So staying ahead of your taxes often requires paying quarterly tax payments. So when you're an employee, your taxes are withheld and remitted with every pay cycle. So that's, twice a month or every other week. So when you're self-employed, you have to pay quarterly. You have to stay on top of it by paying quarterly estimates. So those are in April, June, September, and then January of the following year. So what we'll generally do is with your tax return, we will provide estimates that you can pay. Those are calculated based on your prior year's tax. That's called the safe harbor method. But we like to check in with you each quarter to see what's been going on. Obviously, there's a lot of volatility in the market. So last year you may have, closed a ton of business, and this year it's a little bit slower. And so, maybe we want to adjust what you're paying in, or vice versa. Maybe you're doing a lot better this year than you did last year, and so we need to up those payments. So that's something that you'll need to stay on top of. And it's another reason why it's important to, keep your books and records contemporaneous, as opposed to waiting until the very end of the year to figure out what you've made and how much you owe in taxes. If you don't properly pay those quarterly estimated payments, the IRS and the California FTB will assess what's called an underpayment penalty. And it's essentially you didn't pay in advance, and so we're going to assess this penalty on you. So we like to avoid that, certainly. It also helps for you to know what to be setting aside from your commission checks. So good rule of thumb is to set aside about 30% of each commission for taxes. But again, if you're using a tool like QuickBooks or even Excel, just to help track your income and expenses, we can come up with a more precise number, on a quarterly basis. So in terms of maximizing your deductions, so you want to keep an eye out for expenses like marketing materials, licensing fees, mileage, travel, meals and entertainment of clients. All of these things really add up. And so the more that you're aware of them means that you can track them and make sure you're not losing out on deductions that you're entitled to. There are a number of apps that can be used. Most commonly, we get questions about apps for mileage because no one likes to, jot down what their mileage was when they start a trip and then after and do the math. There are plenty of apps that I can certainly send out a list, but just to name a few, Mile IQ, Everlance, Hurdler, Stride, and then you have QuickBooks Self-Employed, which also has a mileage tracking feature. So this is helpful because you can then claim a portion of your vehicle expenses, the portion that's allocable to the business use. And similarly, if you use a home office and that's what you work out of, you can claim a portion of your home-related expenses, such as rent or, mortgage interest and taxes if you own, utilities, homeowners insurance or renters insurance, things like that. So all of that really adds up, but it does require you to be somewhat diligent about your expenses as you're incurring them. And I think that's pretty much the bulk of the major expenses that we see. In terms of smart, kind of best practices, opening a separate bank account for your business related expenses, having a credit card and making sure all your business related expenses really goes a long way. That way you're not sifting through your credit card statement and trying to figure out what is personal, what is business. If you have a separate bank account, you can then get a, QuickBooks Online and have that account connect to QuickBooks so that all of the transactions are flowing into QuickBooks in real time. You start to categorize them into different expense categories, and QuickBooks actually learns very quickly, what vendors or what types of transactions go into what expense account. If you have a more, if you have more voluminous activity, a more, kind of robust business that you're running, we're also happy to help with ongoing bookkeeping.
I think one of the things that I wanted to mention that you covered, the prepayments. I think more often than not, the biggest problem for realtors is not making their prepayments and thinking to themselves, well, this is a great year, so I'll pay the tax next year when I owe it. And maybe if it's a lean year, it doesn't work out so well. So making prepayments really saves you a lot of anxiety going forward.
So we have a couple questions in the Q&A. The first being, what are the benefits with an LLC? So that would be the legal protections, which is somewhat outside of the scope of what we can talk about. But Ani, if you want to weigh in with anything else.
I can address that a little bit. The LLCs, my personal favorite is S Corps as opposed to LLCs. LLCs, I've always told my clients that if you want protection from something, you're better off having insurance. Errors and omissions. LLCs will generally protect you from your partners. And, it's a misnomer in tax class. A lot of times, one of the big jokes is that this is a lawyer's something to do because
Ploy.
it's an easy setup.
Yeah.
And if there's no follow through, it can cause problems. If you dissolve your LLC and you don't notify the government, years later, you can find out you owe them for all those years you weren't even in business. So there's a lot of slip ups. An LLC also has a fee plus a tax at a certain level. And so the tax, the $800 is kind of normal because you have that with an S corp. But with an LLC, you can be surprised by your tax, which is not a pleasant surprise quite often when you hit that range.
Yeah, so the tax for an LLC, unlike with an S corporation where it's looking at net income, that net income gets passed along to you on your individual return. With an LLC, it's actually looking at your gross receipts. So let's say you do a ton of business, but you incur a bunch of expenses in doing that. You don't really get credit for those expenses when figuring out the tax due, the gross receipts tax, for LLC purposes. So even though it's called limited liability company, that's what LLC stands for, it's a bit misleading. So your better bet is to consider opening up an S corp, but again, you have to weigh the pros and cons. There is an administrative burden, but you can save on, once you pay yourself a salary, any distributions in excess of that, you then save on the self-employment taxes. So definitely something to consider. You can also just continue being a 1099 contractor and not set up anything and get insurance to Ivy's point. Okay, so for vehicle, best choice to lease, buy cash, or make payments. Do you want me to take this one?
Well, the only thing I want to do while you think about this, is that quite often the answer to this question is personal.
Yeah.
Do you have the cash? Would you rather have it in cash flow? In the end, my feeling is you end up kind of in the same place.
You do. Yeah.
But it really has to do with your personal cash flow and what you foresee for the future.
Yeah, so a lease payment is typically going to be cheaper than if you're financing it, but you have to turn it back in at the end of the lease. There's also mileage restrictions depending on how much you're driving it around. Ultimately, from a tax perspective, though, it does sort of end up the same. Whether you pay it in cash or you're financing it, you get to claim depreciation if you are purchasing it versus leasing it. And then if you lease it, you get to claim a deduction on the lease payments. So there may be some differences there, but generally speaking, if you purchase it and you take depreciation, a lot of that can be accelerated into the first year under Section 179 and bonus depreciation, whereas the lease payments, the deduction you get on that truly is when you're making those payments. But it really should be not driven by taxes, but rather driven by your cash position and your financial goals.
I think another thing for realtors in particular is with a lease, generally you can afford to be driving a fancier car.
Very true.
And I think for all the realtors I've known, this is part of marketing yourself as a realtor. So in that respect, leasing might be a nicer option.
Yes, very true. Okay, can you go over travel expenses? What is deductible and what is considered a business trip? Yeah, so for travel expenses, things like your airfare, your lodging, if you are taking cabs or taxis or Ubers or Lyfts to meet with clients, if you are, presumably you're eating there. So whereas in SF or in the Bay Area where you're doing business, there are limitations on what types of meals are deductible. There has to be, business discussed. There has to be a business purpose to the meal. When you're traveling, if you were on a business trip, the meal expenses that you incur are deductible. To be honest, I can't think of a ton of situations where you'd be doing extensive travel in your line of business. I do see that with, you know, those who are more in like the design or creative space, if they're traveling to meet with clients or to gather inspiration. But because a lot of your business is local to the market, if you want to give some examples of, you know, travel, and we can talk about whether they're considered business travel, deductible, things like that, we'd be happy to do that.
Yeah, so like, you know, continuing education or conferences are deductible, correct?
Oh, yes.
Yeah.
Yes, absolutely true. Yep.
That.
Yeah, absolutely true. Yep. So if you were to travel for a conference, like I know there was one recently in Las Vegas, you would be able to deduct all of the expenses incurred in traveling there, because there's a clear business purpose, and that you are, you know, going not only for the education aspect, but also just to network.
As an example, we have one client in Hawaii who has to go by plane from island to island as she's selling real estate. So that would all be air travel and expensible.
It's nice.
For most realtors here, I don't think we really have had any that travel for actual business. But if you were going to meet a client in Los Angeles or something like that, then that would be deductible.
Clients looking
Be
to
documented.
relocate to the Bay Area, networking. Yeah, both of those would qualify. Absolutely. So you would want to, you know, record, again, if you have a separate bank account, you have a separate credit card, book all that stuff, you know, on that credit card. So it's super easy to track, but it would be the airline, it would be the hotel you're staying in or Airbnb, it would be the cabs, or if you rented a car, it would be your meals while you were there. If you were entertaining the client, that would, you know, still be subject to the entertainment restrictions. But yeah, that's all I can think of that commonly comes up when you're traveling.
Carolyn, just before you answer the next question, I just want to open it up to everybody in person. If anybody has a question, just let me know and I'll interrupt. But
Thanks.
go ahead, Carolyn, oh, there are no open questions.
So the only other question that came up is, again, the leasing versus buying. What are the tax benefits? So there really is no, like, they're pretty similar. The only difference being if you purchase it, you can depreciate it, and oftentimes you can claim all the depreciation in the year of purchase, whereas the deduction that you get for your lease payments is as you're paying those lease payments. So it would be over the term of the lease. So it would just be a timing thing. But in terms of like the actual deduction you get over the life of using the vehicle, it's about the same.
I think that one other question that I've run across recently is around 1099s. So I would like to put out that whether or not you get a 1099 or not, you are still responsible for reporting your income. There is, in fact, no place to attach a 1099 to your tax return. It's informational. It is reported to the government, and so they would then cross-check with your return to make sure that you're reporting at least that much. But should they want to take a look at you, you would have to explain every deposit into your bank account, and they can draw on all your accounts. So it's, you know, you don't want to think that if you don't get a 1099, you don't have to report it. You do. And this is a good place to interact with your accountant to find out if there's other situations where you've gotten money and you've deposited it into your business account, to have an explanation and find out whether is it taxable or isn't it taxable.
Yeah, and another thing is that oftentimes the 1099s, so if I'm looking at someone's QuickBooks and then I'm looking at the 1099 from Kanoko, for example, may be higher than all of the income that was deposited into your account because they took their cut. We still need to report the gross amount to match the 1099, and then we can report their cut as an expense, as a deduction, so that ultimately you end up reporting the same amount of net income, but we have to match the 1099 at least. And again, if you're not issued a 1099, I have personally been involved in an audit where they truly do go through and look at every deposit. If you cannot explain it or substantiate it, they count it as income.
Yeah, and here again, you know, it's the saying, if it is written. So having a document or even having a bill and writing on there, and presenting that will quite often work if you have an explanation. Sometimes it's hard to remember what things were years before. And, you know, we don't know what to expect in terms of audits going forward here. So it's a good idea to write these things down.
I have a question. Is there an income threshold at which you say you should incorporate? And what does that look like?
You know, this is really kind of a gut feeling, and sometimes it amounts to discipline. You know, if I have a client that comes in and brings a paper bag full of things, you know, I might say, this is going to cost you a lot of money. Why don't you become an LLC or become an entity? Oh, so let's talk about entities. So if you become an S Corp or an LLC, it's like somebody else sitting over there. The government is protecting that person. Plus, same with a corporation. It's a different entity. It's a different person. You're one entity. So there's a line between the two of you, and you have to interact. The you know, my gut feeling is if you're making somewhere around 400,000 gross a year, you might consider maybe even 3. A lot of people, I think, start around 300,000, but you know, quite often this is you know, as long as you've got insurance covering you for things, I think that a lot of it has to do with your ability to keep things neat. And of course, by keeping things neat, you don't lose your deductions, you don't lose your information.
And another thing to consider is that once you have paid yourself a reasonable salary, right? So let's say you gross 400,000, and you know the net of that is 200,000. So you pay yourself a salary, and let's say you want to maximize the amount of Social Security and Medicare tax that you pay. And so you take up to whatever the Social Security max is, which is like, I don't know, 165,000 or something like that. And then the rest you take as a distribution. The 165 is subject to the payroll taxes, and that is considered reasonable compensation for you doing business as a realtor. And the rest you take as a distribution. Distribution is still subject to income tax. It's just not subject to that payroll tax component, those Social Security and Medicare tax. So that can be a benefit, but that shouldn't be your primary reason for setting this up. To Aine's point, it does, you know, it requires you to stay organized. You have to have a separate, you know, separate books and records. And that's not just like an Excel of your income and expenses. You have to also have a balance sheet.
I will say, as someone that was a sole proprietor and is now incorporated in S Corp, one of the best things that I did, because I eventually wanted to incorporate as S Corp, was, if you think you're going down that road, start by opening up a separate business account as a sole proprietor and start keeping your books all in that bank account separate from personal, because you cannot commingle funds once you incorporate. Otherwise, it's completely like a breach. So get into the habit of like using completely separate checking accounts and credit cards for those accounts. So that's the best thing I did, because even after doing that for like the first 6 years or 5 years, I still commingle funds in that business account. And as a sole proprietor, it's not a big deal. As an S Corp, it is a big deal. So I trained myself.
So one question, great question. I've heard about a real estate professional designation having tax benefits for owners of investment property. Would you please touch on this? So if you designate yourself as a real estate professional, the benefit of doing that means that your losses from real estate investment are not considered passive losses. So basically, like back in 1986, they started limiting what you could deduct on passive investments. So if you have a loss from a passive investment, it is limited to your passive income. So you can't claim losses in excess of passive income. It carries forward to the next year until you eventually dispose of the passive investment. If you're designated as a real estate professional, then your real estate investments are treated as active income, an active activity or active loss, which means you can deduct them in excess of income. I would be really careful with this though, because if this is not your true like primary business activity and source of income, it can really muddy the waters, and you can't have multiple activities that you're treating as an active trade or business, right? You're going to have one active and then the others will be passive. So if truly you're a real estate investor and that's what you do and that's how you make your money, certainly. But if you have an investment property, but you're also, an agent on the side, or you've got, other sources of income, I would tread very carefully.
Does that only benefit if you have losses? What if you have gains?
Only if you have losses. Income is taxed the same, whether it's passive or active.
I think this touches on maybe aspirations of people in the real estate business. I've known quite a few realtors who, because you're in the business, goals might include buying multiple unit properties and renting them out. You have access to the market, you have access to the deals. And while this would be then come in very handy to be a real estate professional. However, I did have one person who had a realtor here, prominent realtor here, with multiple properties in Florida, and it triggered an audit. Not to say that it should have, and actually he won, but it's a big waste of time and money.
Question about the Augusta rule. Are you seeing a lot of agents use that to deduct the expense of
Waste
hosting
management.
events at their own property or their company? And what kind of range of rates are they charging themselves that you're seeing people get by with?
I have not seen a lot of this. I don't know if you have any.
No, I haven't seen any of it.
Oh, okay. Well, I did it last year and I didn't get on it yet.
That kind of borders, I think, on marketing.
Okay.
It really depends on how you promote it. If you're really just trying to write off your own birthday party, that could be a problem. If you've got pictures of a sign there or literature, if it's actually a marketing event, that's a different story. But I think that depending on how big a portion of your income that is, there are tables that are supposedly used that indicate how much expense would be appropriate in your income level. And so if you're spending 25% of your income on your birthday party, then it's going to trigger some attention, and you'll definitely want pictures of people walking around with your business card and
It's all
possibly
big.
an agenda. Yeah.
Okay.
Yeah, and it's just something to consider, to Aine's point about there are tables. So your return automatically goes through a proprietary software that the IRS has, and it compares based on the business activity code reported on your tax return, generally what the range is in terms of percentage for all the line items on your return. If something is way out of whack, that's going to be a red flag. It may not be enough for it to trigger an examination. That's sort of a black box. And also as a CPA, I am prohibited from mentioning anything surrounding audit risk. So I can't advise you on what's the risk of doing this. Yeah, but just if you've got branding, any sort of branding around an event, that certainly helps.
What, any good, I don't want to say loopholes, but you hear these suggestions of, make your daughter, your marketing intern and put her on a small salary, stuff like that.
Sure. Yeah, so here's I actually get this question quite a bit. So the benefit of doing that is if you're paying this person, let's say your daughter, if you're paying your daughter below the threshold for what's required to file a tax return. So whatever the standard deduction is, anything below that, they don't need to file a tax return. They don't need to have taxes withheld. And so you end up paying them, they're not reporting it on a tax return because they don't have to. You're getting a deduction for it. And then you can take that income and contribute it, or they can contribute it to in a Roth IRA. So the benefit there is, you have to have the earned income in order to contribute that to a Roth IRA. And Roth IRAs, they grow tax-free, assuming you meet the income limitations. And you get a deduction without them having to file a tax return. The CPA in me will say there has to be a business reason for you to be employing them. An intern sounds great.
Years ago, many years ago, if you were a Schedule C, you could employ your children. And this actually came from when you had the family farm. And you could then employ your children and not deduct some of the payroll taxes from their wages. And there was a really good reason to do it. I haven't run across that in many years, though. So I don't even know if that's still a law. Do you?
It's interesting. I get this question a lot. I don't see anybody following through on it. I think there's a lot of things on Instagram that maybe, I don't know, are like life hacks or financial hacks
I think there's a big, there's a big conglomerate of people that are marketing this to run your company and pay your kids as models, having them on the website. You pay them as a model and you do exactly what you just described. Intern, I haven't heard yet, but yeah, there is a lot of people.
I mean, I know some
touting
agents
this.
that use their kids for marketing in the sense of stuffing envelopes and
Yeah, my kids
admin
are stuff
work,
envelopes.
work that they can do, stuffing envelopes, dropping hangers off at front doors, walking around the neighborhood, things like that.
Mhm.
Here again, I think it's a matter of perspective. If you're paying your kids $50,000 a year to stuff envelopes.
Yeah, right.
Right.
And again, if it's 50,000, then that's over the threshold. They have to file a tax return. They have to pay taxes on that, which sort of diminishes the benefit of it a little bit. So you really kind of want to keep it underneath that. I should know off the top of my head what the standard deduction is. I want to say it's 15,000. So if you pay them under 15,000, which for an intern seems very reasonable to me, regardless of what they're doing, it's a good move because of the Roth aspect.
Well, it also if I think the minimum, correct me if I'm wrong, I think the minimum W-2 out of an S corp that you have to pay yourself is somewhere around 35 or 40,000. If you're paying yourself the minimum and each of your kids is getting 15, there's not a balance there.
Right.
So that's a red flag for sure.
Right.
Oh, yeah.
So one thing that just came up was the Roth IRA. And I'm not going to address the Roth IRA in particular, but as somebody who is now looking toward retirement and has been independently employed all my life, I wish I had funded a 401k, a retirement plan, some sort of plan to save up. If you're a realtor, and my husband and I were involved in real estate a lot, so we had property instead of a retirement account. And, now in my older age, I can dispose of property as I need to. But if you're not focused on acquiring property, which I think is a really great retirement vehicle, at a young age, I think I can't stress enough how much you want to
Compound interest.
put money away. Because one day you're going to wish you had.
That's good advice.
Your thoughts on converting traditional to Roths?
I'm in huge favor of it. because of the
Depending on age.
tax-free earnings component.
And just. I know that the tax brackets work as brackets, but knowing that.
You've got the backdoor Roth.
Tell us-
So even if you exceed the income limitations, you can still make a traditional IRA contribution and then have it converted to a Roth. So you don't get the deduction that you would if you made a traditional contribution, the tax deduction, but with it going into a Roth, then the earnings, it grows tax-free. A lot of people think that sounds shady, like backdoor Roth. It does sound shady, but the IRS is very well aware that this is something that people do, and they haven't done anything to close the loophole. So.
I think we have another question up there.
Yeah, a former tax advisor advised better to use a separate EIN versus your SSN. What is the tax benefit of this? There is no tax benefit to this. If you are to create an LLC, a separate entity, you can and should apply for an EIN. It's super simple, and then you would just report that, but there's no like tax benefit to reporting an EIN versus SSN.
Any more questions?
Any other questions?
Oh, this is great.
You have a dumb question.
No dumb questions.
dumb questions.
I have a drawer full of receipts.
A paper bag.
Scanner.
So actually like scanning, saving them, labeling them,
I don't think you
it's
need to.
important.
If these are receipts on your credit card, then on a personal level, I take my credit card statements
Yep,
and I mark them
mark them
up
up.
with who I was with or what, give me a hint as to what's going on. They also then tie into my agenda, my calendar. So in that case, I don't keep receipts.
Same. I download it to Excel. I download the statement to Excel from like Chase Online, and then I add comments in the Excel. And that's a great idea. Actually, I need to look back at your calendar to like jog your memory on like, what was I doing on this day? But yeah, that's like the best. Like
tell you the truth, I like
probably
Excel.
shouldn't say this, but I never like request receipts, say yes to a receipt, save it, put it in it. I know I'm putting it on my credit card or my debit card, and I know I'm gonna have some record of it that way.
I will say too, as SFAR members, you get a free pro account with Hurdler,
It's the best account.
which is great because it tracks your miles and you can.
Yeah, Hurdler was on my list. That's
You
right.
can, yeah, you can annotate anything you pay, so you could say, this was a lunch
Snap a
with.
picture of it.
And you
Yeah.
can take a picture of it on the
Yep.
app.
Take a
Attach
picture of
it to
it,
the thing and then like throw the receipt away.
and
after you
it's
do that.
smart, so it learns like when you're using this card or you're going to this place, that's a business expense.
Exactly. And it
Is it
uses,
like a-
machine learning to start to categorize it like on your behalf, and it makes it really, really easy.
So you get free.
Yeah,
It's
with
free, yeah, so
SFAR.
if you log, so if you go to Hurdler and
That's something
download
that
it, you
nobody
won't
knows.
get it, you have to go through the car website, sorry,
Oh,
it's the
okay.
SFAR
Car,
membership,
yeah.
it's car, excuse me.
Got it.
Go through the car website and download Hurdler through there and it'll give you the free pro account.
It's basically
Yeah.
QuickBooks for realtors.
Yeah, and so
I
that
used
actually.
to use it a while ago. But
Actually, have
But
a
it
question.
tracks your mileage in addition to your expenses.
I have a question.
Yes.
Quick, you mentioned QuickBooks a couple times and I'm wanting to start doing my books more in more organized fashion. Is Hurdler going to give me some kind of tool that will get me there, or should I really invest in QuickBooks and be doing my?
I would invest, and when I say invest, it's
It's not, yeah, but.
very cheap.
Right.
It's so what I see the biggest benefit is like the dynamic link where your transactions are flowing into QuickBooks in real time.
Yeah.
And like similar to what you were saying with Hurdler, it starts to recognize merchants and categorize. So like within 6 months or so of you setting up your P&L and going in there and categorizing your transactions, it's such a minimal lift. You just need to go in and be like, okay, like, is there anything it wasn't able to categorize, or like, is there anything that went into miscellaneous that I need to look into? But it does a lot of that for you. It also has well, invoicing wouldn't really apply to you guys, but if you use subcontractors for anything, you know, you can file your 1099s through there, which is super helpful. And then you can make your CPA your accountant on your account. And then when I go to prepare your tax return, I go into QuickBooks, I pull your financials down and use that to prepare your tax return.
Nice, okay, thank you.
I think one thing to watch, I personally like Excel.
Okay.
So, you know, I think that if you're an LLC or a S corp and you're keeping a balance sheet, this then becomes more complicated. One of the things I see with Excel, and Carolyn touched on this, is that you can't really depend on QuickBooks to know what all your expenses are. They'll take things and put them places where they think it goes, and so it's something you have to check. You can't just take for granted that everything is going to go in the right place. You still have to look at it to make sure that everything is being characterized properly. And a balance sheet is a whole other animal than a P&L. A balance sheet is a list of your assets and your liabilities. So if you own a car, it would be on your balance sheet. Your bank account would be on a balance sheet. And your retained earnings is something that carries forward every year. So if you are not cognizant of what is going on your balance sheet and making sure everything on your balance sheet is in fact something you can prove, then your accountant or tax preparer is going to be spending a lot of time on your tax return trying to get it to tie in to a balance sheet that they are maintaining for you.
Mm-hmm.
Are
There's a
there,
question, do you need to give your contractor a 1099 each time, or when don't you need to? So 1099s are issued on an annual calendar year basis. And it is required if you pay someone over $600 in a given calendar year. So if you pay your contractor under that, you don't need to issue a 1099. If you pay them over that, then you do. So you would just kind of track how much you're paying, and you would get there, you request a W-9 from them, which essentially has all of the information you need to populate a 1099. And then you put in the dollar amount of what you paid and you issue it to them, and then a copy gets sent to the IRS.
would be defined as contractors in that situation? Like a
Photographer.
third party that you.
Photographer,
Stagers.
stagers.
Stagers,
Um,
interior designer, yeah, anything. If you were paying someone to manage your social media.
So
The other thing, yeah.
$600 is gonna be most of those vendors.
Right, now, one thing with the 1099s is I believe it's a $50 penalty if you don't. If you get audited and they say, oh, you didn't give your accountant, who's not a corporation, a 1099, there's a $50 penalty or at least it used to be $50. I don't know.
It is, it's still $50.
Okay, you know, that's $50, which is no big deal.
Right.
But if you pay your sole proprietor accountant $20,000 and you don't issue the 1099 in audit, you can be responsible for the tax on that.
You can't, so
That's where you get hurt.
the way that the IRS substantiates your contractor expenses, so what you pay your contractors, is through 1099. So let's say you pay the $20,000 and you don't issue a 1099 under audit. It's not just, well, the $50, it's, well, you don't get to deduct that $20,000 because you didn't substantiate it with the 1099. So just something to.
You do
keep in
have an
mind.
opportunity usually to go to the person and get them to verify that they claimed it as income and paid taxes on it. But then you're risking, well, they didn't get a 1099, did they report it? And quite often, that's another thing. When you get the I-9 with their information, their name, their address, and their social security number, occasionally things will come up where people are using other social security numbers. It's, you know, you want to be fairly certain that they are using their legal information. Because it will come back to you. The IRS will send you a letter saying this name doesn't match up with this number. Fix it.
And that's in the instance that you are an entity and you are hiring photographers.
Even as
As an
a
independent contractor,
independent
I'm hiring a
contractor as
photographer
well.
to do a listing.
Yeah.
Isn't that just an expense?
As an independent, as a sole proprietor, you
You
are
have to
responsible for
issue a 1099.
Yes,
Cause like photography is like $1,200 minimum, you know,
Yeah.
like on a listing.
you are responsible for
You
issuing.
are- Yeah, you should be
1099.
issuing a 1099. There's a question about, do you issue a 1099 to incorporated vendors? No, you do not. If they are incorporated, when you say, hey, can I have your W-9 so that I can issue you a 1099 at the end of the year? They'll say, you don't need to, I'm incorporated. And you say, okay, well, give me the W-9 showing me that you're incorporated and I won't issue you a 1099.
So if they're a company, you don't have to issue the
If they're a
1099?
A
corporation,
corporation, if they're, yeah, so like
So if they are an LLC.
As long as they're
LLC, you do need to issue.
LLC, you do.
it's a
S corp-
corporation that is exempt, not LLCs, not partnerships, and not
Yeah.
sole proprietorships.
And then can you deduct a virtual assistant in the Philippines? Yikes. You can deduct, when it comes to a 1099, oh, this is complicated. So if you just get a virtual assistant through a third party that's like in the US that uses someone in the Philippines, the reason I say that is because that's considered to be something you have to like withhold taxes on their behalf for if it's someone that's in non-US. I just try and figure out a cleaner way to do it is all I'll say. Yes, using a third party who hires. Okay. Yeah. So issue a 1099 to them and you can deduct it. Yeah, that's totally fine.
Are you clear on the 1099 issue?
Yeah, no, it just, I get it, I just,
Surprise.
it's just like, it's, if I'm paying for photography for a listing, like, it's an expense, you know, like.
Yeah,
I'm not thinking about, I'm a sole proprietor, I'm not incorporated an entity, I'm like. For me to have to issue a
But
10,
think about it this way, like even though you're just a sole proprietor,
I'm still gonna,
the IRS cares because how else, in theory, let's say corporations weren't exempt and everybody gets a 1099 if they receive over $600. That's a way for the IRS to ensure that you're deducting it and there's a,
Paying for it
matching
too.
income being reported. The only way for them to ensure that is you tell them by filing a 1099.
your handyman, you paying cash, can't really do that.
You're supposed to, right, I mean,
Yeah.
listen, yeah.
500.
Right.
Yeah. That's probably the biggest one, yeah.
That's what
Which,
those ones.
that may be part of the deal. If you tell them, I'm gonna
Oh,
issue you a
exactly. They don't-
1099, they may
totally.
say, well, my rate's just doubled.
Right.
What has changed from last year, if anything, that we should pay attention to, and are there any?
Very, very, I mean, other than the standard increases in like your standard deductions, it's the same and it's going to be the same, assuming the Tax Cuts and Job Act, TCJA of 2017 that Trump passed, if he extends that beyond the end of this year, then things will continue to remain the same. The only thing that he is looking into is how to expand the $10,000 limitation on tax deduction, which obviously negatively impacts people who pay a lot in property taxes and state income taxes like Californians.
That's a fun question.
I can't read it. Can someone read it?
I'm
Yeah, we
blind.
could-
I even have glasses on, I can't see.
Might be too granular, but I share the VA with another woman who pays the bill and I reimburse her. Do I fill out a 1099 for the person I reimburse?
Yes, you should. Because then she would report that as income, and then if she then pays the woman, she takes that expense. So yes, you should. Is the PTE? Is that what you meant? The pass-through entity election worth the effort for S corps? I would say, okay. One, I don't want to say 1000%, but like, so the benefit of a PTE is that it's a way around that $10,000 limitation on taxes on your Schedule A. So if you make the election, you pay your state taxes at the entity level versus having them passed on to the individual where you can only deduct up to $10,000 of the taxes that you pay. Does that make sense?
So it is another calculation.
Yeah, it is.
On its own. It is a piece of work. If somebody wants to do this and they give us the data and we have to compute it, it is billable work.
Because it's a separate form that has to be filed. It's separate taxes that have to be remitted. It's something additional on your K-1.
Generally, really high earners would consider this. I only have a few people that do
Only
that.
matters if you're itemizing your deductions. So if you are a renter and you don't have mortgage interest or don't have other itemized deductions that are putting you above the standard deduction, probably you're not really, I mean, you are, if you're not itemizing, you're not going to see the benefit of this.
What do you think of that question?
What is considered a high earner? I plead the fifth. I no longer live in California. I live in Austin, Texas. So I plead the fifth.
You know, I think that in California, it really depends where. You know, I think if you live in Marin County, San Francisco, Woodside, you know, you may be looking at a high, you know, it's not so much that you're a high earner, is what does it cost you to live in a place that's very expensive? I think California is one of the most expensive places to live in the country. And there are parts of California that are higher. I think if you're based in California, in San Francisco, you know, I almost feel, and this is terrible to say, but $100,000 is not that much. A high earner, what is a high earner? I would say over 500,000 a year. You know, it's just sad to say because there are people in other parts of the country that would be
That's
aghast.
their lifetime, yeah.
You know, and especially when you're in real estate, you know, you can sort of judge that by looking at what does real estate cost here as opposed to in Kansas. And, or Austin, maybe. I don't know. Austin's coming
Yeah.
up in the world as
It
well.
sure is. But we bought before it came up. So we're on the up and up.
But it's pretty shocking, you know, and if you travel around the world, it's, you know, and look and see what people, there are places where making $30,000 a year is upper middle class.
Yeah.
So it's all relative, but then of course we have the benefit of living in a place where we eat fresh fruit and vegetables and drink clean water and have our streets cleaned and the fire department comes when you call them.
Yeah, having moved to Austin, I can say the Bay Area is the best. If I could afford it, I would be there. It still has my heart.
One day you'll be back.
One day.
Meals and entertainment, what's that threshold?
Yeah, meals and entertainment, there is no threshold for that. It is subject to a 50% limitation on the deduction.
And the thinking there is the government's not going to pay you to eat, but they'll pay for your guest to eat. And entertainment, I think, didn't that go away last year?
Yeah.
Yeah.
Yeah, so it's really meals.
Mhm.
And then because of COVID, you had 100%. Is it still the same this year?
So dinner.
No, it's down, it's back down to 50.
Back down to 50, okay.
Yep.
Yeah, so entertainment, you know, gone is the day when you could buy baseball tickets for you and your friends and call it a business
I
expense.
think the only time meals would be 100% is if it's like a part of continuing education conferences and things like that.
That would be
So
travel.
travel meals is different.
Yeah.
Travel
Yeah.
meals is different. If you are traveling, then fully deductible. However, if you are having these meals at your home, like around your home base, that's when it's subject
That's
to.
actually a good.
If we have to
that's
travel to a meeting in Chicago and watch a Cubs game.
Yeah.
If you're paying for the Cubs game, no, but,
Trying to find the holy grail.
you know, some of these things are really not worth taking
Clients and
a
top.
chance on. You know, and it depends on how close to the line do you want to get. You know, keep in mind that you may have to explain something to somebody if it's outrageous.
Yeah.
You know, some of these ball games and concert tickets are a lot of money.
Heine loves my questions. She tells me no a lot. I try.
Yeah,
It's a good question, but no.
yeah. Oh, we have quite a few questions here now.
Anonymous?
Do you want me to? Yeah, pretty simple.
Regarding meals, if you split the bill with your dining companions, can you still deduct half of your portion?
Yes.
Then if you have a business meeting with your business partner over a meal, then it wouldn't be tax deductible at all.
No, it would be up 50%.
And then what about client gift limits?
Oh, that's
Client gift limits. Okay, so this question always comes up. So the limit is $25 per person per year.
Per person.
The way around this is to pay for the home warranty on behalf of your clients as a gift. That's fully deductible.
Okay, and then someone's asking again, what's you prefer QuickBooks versus Hurdler?
Yeah, kind of, I would say hurdler until it becomes too much to manage and then move on to QuickBooks, scale up.
Turtle you can use for phrase of agent.
Yeah,
Is the $25 gift just for deduction purposes? Like you? could
just
give-
for deduction. They're not gonna like prevent you
you
from
give $100
giving
bottle of wine,
your
you're-
client a gift over $25, but you won't be able to deduct it.
Okay.
Yeah, that sort of doesn't make a lot of sense. What can you get for $25?
Yeah, that, by the way, that $25 has not changed as long as I've been doing this, which is 15 years.
Yeah.
We got 2 minutes until this is done. Anyone else have questions?
What's the best way to approach you guys? Like, just show up with a bag of receipts or schedule a?
Hell no, we'll turn you away at the door if you show up with a bag of receipts. No, I'm just kidding. Generally like I'll just speak for myself here. Shooting an email, and I think Charlie, you can probably provide our emails, right? Shooting over an email, then we'll have an introductory call just to understand kind of what your tax profile is, what your needs are, explain a little bit about how we approach things. And then if all goes well, we send you over an engagement letter, and we go from there.
So why don't Cam, you have a list of everybody that's signed up, right?
Yes.
So we can just send up a follow-up email with the contact information.
I would like to insert something here. Accountants are being targeted for access to our records online. So everyone is in our industry is being super safe.
Yeah,
We
so
do not
a lot of
take
phishing
client
emails.
Who just emails us and says, hi, I'm so-and-so, and this is my situation. Are you taking new clients? You need to tell us where you are referred from.
Yes.
Otherwise, we will just delete it.
Mhm.
We won't take any clients that we don't know where they come from.
Trust me.
They have become so like crafty. They'll
Yes.
like email and just say, hey, I found you on Google and I'm married filing jointly and I have a Schedule C. Here's my last year's return. Take a look at it and let me know if you can work with me. And then if you open up the file, it's, bad news.
Yeah, or they'll say, had a great conversation with you 2 weeks ago or last month, and here's my stuff. Yeah, it's we have to be super, super careful.
We are at our time limit for this, but we do have a happy hour afterwards, and Heidi's gonna be coming, I believe, with us to the happy hour at Hazy's.
I
And
believe I'm hosting.
she would love to answer any one-on-one questions for anyone who's able to come over there with us.
Sorry, so two more. Can gifts also be considered marketing? Totally depends. If it's branded stuff, certainly. What is the number one tax deduction people fail to make? I think failing to properly account for your mileage. And I would say what I see most commonly is if you're doing any sort of continuing education, any softwares just to stay, organized, whether it's for invoicing or for branding or for whatever it is, any sort of subscription that you're paying for. Those are big ones.
Correct me if I'm wrong, on mileage, it's also good to get your total mileage for the year, not just your
You
business.
have to have your total mileage and your
So you
business
have to-
mileage. That's how we figure out the percentage that relates to business.
It's not just keeping track of your business miles.
Well, I think I'd like to thank everybody for
Thank you.
listening to us.
Thank you.
Feel free to contact us if you need more help.
Appreciate
And
it.
it's not, I want to say, it's not too late. We are still accepting clients.
Thank you.
For the
Fantastic.
next